The reality is, SpaceX is going to be the 5th largest public company in the US on Friday. It seems completely counterintuitive for other major ETFs and indices to not include the 5th largest public company in the US. At a certain point, you've got to change the rules to reflect the market.
Hi, everyone. I think there is no better time in history of the US stock market than now, this week, to talk about IPOs, because this Friday, SpaceX will go public, the largest IPO ever. I have to mention that due to some compliance reasons, Stephane, who works for Deutsche Bank, cannot talk about specific companies like SpaceX because the bank is on the deal. But luckily, we have Paul for that. He's the company where he works, so they're the largest holding is SpaceX. And Paul, based on the most recent reporting, we see that the deal is now 4 times oversubscribed. Based on what we hear from our sources, SpaceX is not going to increase price or the number of shares. So what do you expect when it starts trading? And also, fundamentally, what do you expect based on information from its filing?
Sure. Thanks, Natalia. I think, as you mentioned, SpaceX is the biggest position in our portfolio at $17.89. We invested in 8 tranches across SpaceX, XAI, and X. We were excited at every step of that journey. The company has augmented its financial profile through those mergers. And we look at a business with close to a $30 trillion TAM, 3 subsidiaries, which each have over $1 billion of revenue, which has never been seen before in the IPO market. Each of those subsidiaries would be the biggest company within their sector if they were standalone businesses. Biggest space company, biggest satellite company, biggest AI model and digital infrastructure company. So it's a scale that's never been seen before in the IPO market. And when you look at the numbers, the number 60 is very important when you think about SpaceX. So 60% of CapEx right now is being spent on Starlink. On AI. And 60% of revenue comes from Starlink. So you've got a very well-balanced business, stable cash flows, durable revenue coming out of Starlink, with the growth engine coming out of AI at 60% of CapEx. And when you fast forward to 2028, 60% of revenue becomes the AI business. So why is that relevant? I think when the public market looks at SpaceX today, they see a rule of 60 company. 30% revenue growth today, 30% EBITDA margin, combined 60%. What's most interesting based on that algorithm is when you look at the sell-side forecast from the bank underwriters, they're forecasting a 100% revenue CAGR over the next 5 years, which if that plays out, you go from $20 billion today, the biggest revenue scale ever for an IPO, to $1 trillion of revenue in 5 years. So I think that's why the market's so excited. That's why you've got an IPO that's 4 times oversubscribed. And as we saw with Alibaba over a decade ago, that was a 20 times covered $25 billion IPO, so $500 billion of demand. SpaceX is getting close to that and probably exceeds that, whether it's today or tomorrow or in the immediate aftermarket.
It's definitely a massive deal. And Stephane, there are lots of conversations that as we get SpaceX going public, then potentially OpenAI and Anthropic, so these huge IPOs can absorb liquidity from institutional investors, which could potentially make it more complicated for other companies to go public. What's your view on that?
Yeah, there's been a lot of work that's been done around that, particularly over the last couple of weeks, by strategists, by banks. And I think there are a couple ways to look at this. I think the first one is if we take a historical lens and we compare 2 crude measures. Number one, what is the amount of equity that we think will be raised in the US market this year, divided by the combined market cap of, let's say, the S&P 500, right? So in 2020 and 2021, which were big issuance years, last time we saw substantial equity being raised in the US market, we had just under $500 billion, so just under 500 billion of equity raised. The market cap of the S&P 500 was around $35 trillion. Okay, so slightly over, about 1.5% was raised of the combined market cap of the S&P 500 during those years. right now, the S&P combined market cap is 65 trillion. At the end of this week, total issuance in the US should be about 300 billion. And if we run on a continued run rate, 600, 650 billion, we're effectively raising about 1% of the S&P's market cap. So that, I think, is one way to look at it, and in terms of the available, sort of the supply versus addressable market cap. The other dynamic is a lot of the market cap has gone into the largest companies in the world, right? The Mag 7. And there's been some analysis that's been done around that, which is what is the actual stable capital that owns the Mag 7, and it's about $20 trillion between the top 50 active institutions, the top 50 passive institutions, and then retail, which owns on average about 30% of that 20 trillion. So there is a very deep pool of capital that's invested in these large companies, and if anything, the performance of those companies has reinforced those investors of their desire to buy more. Yep. Which I think takes us to the other point, which is a lot of these companies that are potentially coming to market have raised a lot of capital, but they've made investors a lot of money. So there's a natural, I think, propensity for investors to support these companies as they get to the next stage of their maturity cycle. And if we, putting aside some of the macro and some, what's going on in other parts of the world, the economy is in relatively good shape. Yep. And, when you have big equity issuance years, when the market's in good shape, that's usually quite positive. It's something else if we were going through a big deleveraging or big economic contraction cycle. Then we can ask those questions about absorption. But I think in the current environment, it's relatively straightforward. And the Alphabet transaction last week, you highlighted how quickly it was to turn on the switch for very large fundraisings in equity capital markets for proven issuers. And a lot of the companies that will come to market are proven in one capacity or another.
The market is definitely in a good shape, apart from the most recent sell-off. But you mentioned retail, and it's also a huge component right now of the IPO market as well. So Paul, I understand that everyone is bullish on the stock. We talk a lot to retail traders. One of the stories we are doing for Bloomberg right now is how retail traders are actually taking loans to get more cash ready to deploy for SpaceX. But my question is, what can possibly go wrong on Friday or on Monday when the company starts trading?
So Polymarket, as of this afternoon, has SpaceX trading around 2.1 to 2.2 trillion. So call it up 20% from the IPO market cap. You look at what could go wrong. Yep. Probably three things come to mind. One would be the company has to hit their numbers. I just talked about a path to just under 100% revenue CAGR over a 5-year period. There's never been anything in the equity market at that scale and that growth rate in such a short period of time. So the company has to hit their numbers. Presumably they've been haircut for beat and raise. But that's a massive transition from a majority satellite revenue business to majority AI revenue business. Although I would say with the $1 billion per month contracts signed with both Google and Alphabet, they're definitely doing a great job of showing the proof points in building out not just an exceptional model business, but also a digital infrastructure business. So they got to hit their numbers. That's point number one.
Yep.
Point number two is, and this actually goes for SpaceX, OpenAI, and Anthropic, when you think about mega IPOs and you look back at the last cohort of high-profile jumbo IPOs in tech that had deep cap tables prior to going public based on large capital raises in the private market, you think of companies like Facebook and Uber, and there's a much longer list. But I mentioned those two specifically because Facebook, since going public, has had roughly a 20% total return CAGR versus the S&P at roughly 14 or 15%. So it's outperformed by 500 to 600 basis points versus the benchmark. Uber, on the other hand, has returned about 6% per year since going public versus the S&P over that time frame at roughly 13%. So it's underperformed by about the same margin, roughly 600 to 700 basis points. So point being, you can have diverging outcomes, obviously very different businesses, but both had deep cap tables prior to going public based on large private capital raises. And that's the type of stuff that could go wrong if you've already oversaturated the market. The incredible thing when we think about this jumbo $75 billion IPO is that ironically, the biggest equity capital markets transaction in history was in the private market.
Yep.
When OpenAI raised $120 billion. Incredible. We raised $14 billion for Ant in 2018, and that was a huge achievement at the time. OpenAI did 9 times that. So that would be risk number 2. Risk number 3 is, frankly, just opening the stock. And you're talking about an unprecedented quantum of liquidity. I mean, I think the stock should trade 30 to 50 billion plus day one, potentially more. Okay. Could easily overshoot that. And you got to make sure that the NASDAQ can handle it. We have the utmost conviction and faith in Adina and Nelson and Bob and the team at NASDAQ that they're going to do a great job, but that's a lot of liquidity for a single name in what's likely going to be a very compressed trading time frame.
So talk to us a little bit more. What can go wrong with trading at NASDAQ? Like, what is it?
Well, I remember when we took BATS public, or tried to take BATS public on the BATS stock exchange, and it never opened because the exchange broke. But I don't think that'll happen with NASDAQ. But I mean, is that technically a risk? Yes. It's more of a technical risk, but I don't think it's a high probability.
Guys, we also have lots of conversations about should major benchmarks include big companies and indexes sooner? Stephane, what's your take? Do you feel we are like in the beginning of this new trend, or it's not going to happen with other companies?
The indexation trend has generally continued to move relatively quickly between, passive money as a percentage of active money, and increasingly the index providers have been sophisticated in adding specific indices. So even though some companies won't enter, the largest indices immediately, there are still candidates for a handful of relevant indices. But when you have companies of this scale, whether or not the index is immediate or it's progressive, ultimately these companies will become staple investments in portfolios. So investors will be prepared to take some degree of tracking error, and then ultimately at some point we would expect the indices to include these companies. Mm-hmm. But having making exceptional rules for certain transactions is probably somewhat problematic for some of these index providers who are ultimately trying to open up the stock markets to everyone.
And the reality is, SpaceX is going to be the 5th largest public company in the US on Friday. I think it's brilliant that Adina and the NASDAQ team fast-tracked it for the NASDAQ 100. It seems completely counterintuitive for other major ETFs and indices to not include the 5th largest public company in the US. At a certain point, you've got to change the rules to reflect the market. And I don't think when those rules are written by the S&P or Dow Jones that they anticipated companies going public that day one would be among the 5 largest companies in the country.
I know there is a lot of excitement about SpaceX and future IPOs, but we have to take a step back and look at performance of companies that went public this year in 2025, because the picture is really mixed. We see a big jump on the first day of trading, then we saw declines in many cases. I have the same question for both of you guys. How do you explain this volatility in the stock market, even with some companies, for some companies that have really strong fundamentals? Paul, you want to take it first?
I think it's 2 factors. One is because after the Sequoia letter was issued in early 2022, urging private technology companies, but then public tech companies followed suit to cut growth and pivot to profitability, the top decile of public growth companies, most of which are in technology, are growing at best 25 to 30%. And the companies that you're referring to in the growth in the tech IPO market, most of those companies were trading or were coming out as public companies well in excess of that 30% high watermark for growth. So of course there's going to be exceptional demand. It's become very easy to end up 20 times or more oversubscribed for those IPOs. Cerebras, which is another portfolio company, is a great example of that. There's so much pent-up demand by growth managers in the public equity market that are starved for growth that have to buy these IPOs. Then what happens? How do they manage the risk? They get an allocation on the IPO, they get cut back dramatically relative to how they want to size the position, and they look at their weighted average cost basis, which is their position at IPO, and then they'll pay up in the aftermarket, and they look at that blended weighted price as their basis. That doesn't mean that they're going to continually buy at that elevated peak price. And you see that happening time and time again in the public market. Eventually that bid falls away and the stock settles at a more naturalized, fully distributed price. The good news is if the IPO is priced correctly, the sell-side research comes out with still further upside in their price targets. Again, Cerebra's a good example of that. You saw some of the big banks like Citigroup, my alma mater, published research earlier this week coming out with $300 price targets versus the stock pricing at 185 and trading to 225 to 230. So I think that's the dynamic that we're seeing in terms of a big pop day one or week one, and then coming back to a more normalized appreciation versus IPO price.
I see. Stephane, what's your take on that, and what does data show you?
I mean, I agree with what Paul said. There's also this element of different cohorts of investors, right? So certain investors get prioritized during the IPO, and then others are scaled back, and their allocations as a percentage of their demand is much smaller. That may include retail in certain instances, and retail sometimes doesn't have the same fundamental constraints that certain institutional investors will have, and they might be inclined to, in the first week, chase the momentum, right? And then once some of the excitement from the IPO, some of the pent-up demand, some of that fear of missing out fizzles, then ultimately the stock sort of gets back down to a more normalized area. And then the question is, where is the marginal buyer? Because IPOs tend to go up not because it all comes down to the marginal buyer. Who is a marginal buyer after the stock is trading? And is that marginal buyer someone who has gotten already a lot of stock, or is someone who's been scaled back and is very excited about piling in? So when we look at typically between day 1 and day 30, if we looked at IPOs in 25 or 26, the performance has about halved. So in 25, for example, day 1 pop on average for the US IPO market was about 22, 23%. You looked at the same statistics by day 30, it was about anywhere between 11 and 12%. So you can see that normalization trend that Paul was alluding to.
Well, I'm sure it makes investors' life more complicated because you have to choose right companies, look at valuations, etc. Let's talk about, Paul, how you guys find companies, how you look at your positioning across different sectors and metrics.
We only invest in the private market. And we only invest in the US. So we start with all private US technology companies and then look for what we think are going to be the winners in each subvertical. That's every part of AI, from the model layer to application layer, chips and infrastructure, as well as sectors like aerospace and defense, broader defense tech, next-gen software. The KPIs that we look for are companies that are hurdling that top decile of public equity growth. So our minimum revenue growth threshold on a multi-year basis is 30%, and the median revenue growth in our portfolio is 90%. And importantly, we marry with that a path to profitability. So a third of our portfolio companies either are cash flow positive today, like Ramp and Deal, or have a path to free cash flow within 12 months. The remaining 2/3 of the portfolio, we want to understand the underwrite to free cash flow. It could be a year, 2, 3 years from now, but we want to understand that if they had to pivot to free cash flow because market conditions change, they could still hurdle our 30% revenue growth. That's how we've added positions to the portfolio like a Databricks, Ramp, Deal, Anduril, Hadrian, and the list goes on, using those types of KPIs.
So where can you forgive lack of profitability?
Sorry?
Where can you forgive, like in which companies or areas where you can ignore that the companies are not profitable at this moment?
Anduril is a great example. When we underwrote the Series G last year, we were the only new investor that was at $28 billion. That was a decade-long relationship between their founders and our team. And the model at that point in time forecasted burn for 5 years. And we looked at that and said, let's sensitize the model. If market conditions change, private companies become starved in terms of access to capital, if they had to be cash flow positive, what would that do to their growth rate? And we ran the sensitivity, and in our analysis, they would still hurdle 30% revenue growth. So they wouldn't be growing 50 to 60%, but they could still grow north of 30% and pivot to cash flow in a very short period of time. And that was a key test, and it's probably the best case study for that type of analysis that we run.
I see. Stephane, are there any areas where you think like some specific sectors are out of favor right now? Because we saw, of course, huge spike in companies from biotech sector going public. Then we saw a huge wave of crypto companies going public. Is there any sector that concerns you guys right now?
There isn't any particular sectors that concern us. What we would say is that the market this year has been relatively narrow in terms of the sectors that it has really embraced. And it is exactly the types of sectors that Paul was alluding to. So, there's quantum, there's semiconductors, which are, effectively the technology around AI. But in particular, there's electrification and the powering of AI. And then if we fast forward and we, ultimately as the AI infrastructure becomes more and more valuable, including, critical minerals, then countries have to defend those resources, and therefore there's a natural corollary that you have to go in and start protecting your assets, which are becoming increasingly valuable as we've seen with the improvement in some of these valuations. So the market is very focused, if you will, on those four corners of the market, and is effectively putting a premium to those. I don't know whether your question is saying, is the market putting a discount to others? Mm-hmm. I think that the market is incredibly excited about certain sectors right now and is willing to put a lot of time and capital behind those.
I see. Paul, could you maybe name a few companies that are the next rising stars, apart from 3 big IPOs that we expect next year? So if people were thinking about deploying fresh capital right now, what are the best companies to invest in?
I mean, I look at our portfolio. We've got 40 portfolio companies. We've deployed over $1.5 billion in the late stage growth equity market. Based on our underwrite and other funds that we partner with, as well as interest from LPs, I mean, the names that come to mind are names like Anduril, Deal, Ramp. I think you've had this incredible period of AI disruption, and the companies that rise to the top and that continue to grow, beat their benchmarks, have exceptional revenue scale, growth, and a path to profitability are the ones that we want to continue backing with follow-on raises. So we've done multiple rounds in Ramp, multiple rounds in Databricks, multiple rounds in Hadrian, Reflection AI in the open weight space. So, we're looking for those companies that have a really durable moat and that are compounding at scale.
Yeah.
And the good news is, I think with this wave of mega IPOs, while you're going to have some companies step back, as you heard Ali Ghodsi from Databricks say last week, they're not going to rush to go public. But I do think with 3 of the biggest companies in the world in the private market going public, it's going to compel a lot of private companies to access the public markets. At the end of the day, the public equity markets are the most efficient place to raise capital. It's much easier, much bigger quantums of capital. You're even seeing the mega cap companies like Google coming to market with large raises. So I think from that standpoint, it's encouraging to finally see some of these monoliths come to market, go public, and then pave the way, I think, for more IPOs within the tech space. Mm-hmm.
Well, I'm a journalist. I have to ask questions about what can possibly go wrong. Stephane, let's talk about the macro picture. We see this sell-off in the past few days. Maybe some people are just selling positions because they want to invest in SpaceX, but there are lots of concerns that rates will stay elevated. Now the market is pricing in 1 rate hike this year. People also expect that inflation can remain elevated longer than they had previously anticipated. So what is your view on the macroeconomic environment? Let's say if oil stays at this level for longer, do you think it's going to be a concern for the IPO market, or the market has become so much more resilient versus like last year when we had this tariff turmoil? Like, how do you see the macro picture and what it means for the IPO market right now?
So the market has certainly been a lot more resilient this year with respect to geopolitics and also just the changing or any variability in the tone in the Middle East. I think there is, for now, a much greater tolerance for $90 a dollar oil, particularly in the US market. I think other parts of the world have had a much harder adjustment phase, and it's had a much greater read across into inflation. Thankfully, the inflation numbers this morning were not too bad, and the market took that relatively well. But the market will continue to watch inflation. Our teams had done some work around at which point does the American consumer really get affected, and it was levels much closer to 150 than 90, particularly given some of the big, beautiful bill stimulus impact. So therefore, the American consumer for now can absolutely tolerate it. Interest rates and yields have started to rise, but they seem to be in a channel. If we have a big change, that will have an impact on markets for sure. One of the questions that people may have is what happens when we have two companies that are potentially in the same sector coming to market at the same time. And a good example of that was in 2019 when Lyft and Uber came public. So Lyft went public in March 2019 at a valuation market cap of about $25 billion at the time. And actually, the IPO priced above its initial range, and it traded up 9% on the first day. However, in the following 2 months, the stock dropped 30%. When Uber came to market, it actually came to market below the $100 billion that people thought it would come public at. And it actually traded down 8% day one. Now, what happens in the short term doesn't really matter, because you look at the comparable valuations of Lyft and Uber. Now, one's a $5 billion company, the other one's a $145 billion company. Things can evolve, over time. But clearly there is, there are good examples of companies that can go, and ultimately over time, when sectors are growing fast, they need capital. There are plenty of instances where a number of companies in the same sector have accessed the market at the same time. And in fact, what you see is investors become more and more sophisticated and understand what they're buying even more. Yeah. And that was particularly the case, for example, with private equity companies that all came public within a short space of time, and the amount of capital and the amount of institutional knowledge actually improves in that period.
Right. So I know you can't talk about specific companies, but we all know that two of the biggest companies from the same sector that could possibly go public at the same time right now are OpenAI and Anthropic. Everyone is excited. Paul, what is your take? Does it matter who goes public first?
Yeah, I think there's definitely a point in time where the market's saturated when you have too many IPOs, too much capital raised in a certain sector. That being said, these are clearly three must-own public companies.
Yeah.
What's interesting when you look at the KPIs of the businesses, SpaceX on an LTM basis growing 30%, and we talked about, based on sell-side research forecast, the path to 100% revenue CAGR over 5 years. But right now, the company on aggregate is growing 30% on the top line. You look at the average run rate revenue for OpenAI, it's implying 200% year-over-year growth. And you look at Anthropic, and it's growing year-over-year 1,400%. Mm-hmm. So 7 times greater growth when you go from SpaceX to OpenAI to Anthropic. Now, I'm not sure the order of the IPOs will fall in that same cadence. It feels like, based on filing timing, it could be SpaceX, Anthropic, OpenAI. But either way, these are exceptional growers at unprecedented revenue scale that the market's going to have to own. Again, we're investors in Polymarket. We look at Polymarket's prediction analytics for where things are going to trade. There would still appear to be upside based on what the market is saying right now through prediction markets. Anthropic today is valued at $2 trillion. OpenAI is valued at $1.5 trillion on Polymarket. So meaningful appreciation and headroom relative to where they most recently raised in the private market. So I think we're excited to see all three go public and pave the way for more IPOs in tech.
Great. We have 20 seconds left. Stephane, what would make you advise a company not to go public right now?
If they're not ready. the number one advice we give to companies is get ready, because I think Paul alluded to, it's very important in the first 2 quarters to really hit and beat your numbers.
Deliver earnings.
Yeah, deliver earnings. So if you're not ready, which is what we saw in some cases in 2020 and 2021, some companies ultimately their share prices declined and it took a while for them to recover.
Thank you so much, guys. It was a pleasure. Thank you so much, guys.